Hey guys, today we're going to talk about how do you decide which products to invest in. So, this training is for you today if you're an Amazon or e-commerce seller and if you really want to go beyond just launching a product, but if you really want to maximize your profitability, your cash flow, and your exit value. So, I'm thrilled to have Tyler Jeffcoat with us today. He's going to share you the basics of using return on working capital to decide which products to invest in. So, welcome, Tyler. How's it going?
Gary, things are great, buddy. Good to see you.
Yeah, it's great to see you. It's great to have you back. Tyler is an alumni speaker at Seven Figure Sellers Summit. He comes highly renowned. One of our previous podcast guests, Aaron Hughes, is part of Tyler's Seller Roundtable Mastermind. So he actually leads an inner circle of very successful brand owners. Tyler himself has actually built and exited two companies. He's exited Seller Accountant when he was actually wearing that hat the last time we had him on Seven Figure Sellers Summit. He's semi-retired now, but he's still in it, and he's a CEO, CFO, coach for ecom brands. So today, Tyler's going to walk us through this. And before we get started, Tyler, who's this training for and why is it so important?
Yeah, thanks. Well, again, Gary, thanks for having me back. It's when I saw your email, I was excited to get to reconnect with you. I mean, guys, we have got to get better at deploying our limited resources really well. In a world where interest rates are almost zero and cash is really easy to come by, we can choose to be really, really aggressive. But when things are tight and there's lots of tariffs, interest rates are still kind of crummy. We have to be really good at selecting the right products, the right narrow strategy. And so I think if you find yourself resonating with that statement, I don't know which product to invest in, A versus B, TikTok versus Shopify, Amazon versus something else, right? If that's you, then this next little bit might be really helpful.
Yeah, I feel like a lot of sellers they're overlooking that component. I mean the traditional way of choosing a product relies heavily on software and keyword search volume and competition reviews and trying to pick something that's within a certain price range, but profit isn't one of the variables that most people even look at initially or even at all. So I think that this is super important right now, and I'm curious, Tyler, what are some of the biggest mistakes you're seeing when it comes to sellers deciding on a profit? I mean, a profitable product.
Yeah, I think two of them that came to mind when you asked the question there, Gary. One is maybe the inverse of what I said a second ago. It's really tempting to get overextended, to be stretched too thin, to try to invest in 10 different products at the same time when you really only have the cash to safely invest in a couple. That's the first issue is trying to do too much at once with limited capital. And then the second one is kind of aligned with that is we can become so focused on just the profit margin that we ignore cash flow. And there are so many products out there, Gary, where having a terrible cash cycle, like maybe I have to sit on 2 years worth of inventory, can totally destroy the economics of having an otherwise good product.
Mm, very interesting. All right, Tyler, without further ado, would you like to share your screen and we'll get this started?
Sure. Let me get it presented here. All
And
righty.
for those of you guys joining on the audio podcast, we also will have a YouTube complement. So if you guys want to tune in, definitely tune in. But we'll do our best to share with you over audio as well. So Tyler, it looks great.
Way. Yeah, and I will say this, if you guys are listening to this audio, I just know there's nothing, more annoying than having somebody talk about numbers and math on an audio podcast. So I will try to make this very easy to digest, even if you're just listening to me. And if something really resonates, I definitely want you to take Gary up on his offer and go watch the video because I will have some slides that kind of help illustrate. So Gary introduced me. I'm the guy that founded Seller Accountant. Still an amazing company, by the way, if you're looking for bookkeeping and really kind of that kind of fractional CFO, seller accountant's awesome. Those guys are great. I sold that company a little about a year ago, and to focus on coaching CEOs and to focus on being a CFO myself of a private equity group where we own a few Amazon assets. I live here in Athens, Georgia, with my wife and daughters. Prior to my current venture, the Sellers Roundtable, I've again, like Gary said, exited a couple of other companies. But let's talk about some nerd stuff here. So it's really important as investors, and we are guys. We're not just Amazon sellers or brand owners. We are investors in our machines, in our businesses. We've got to start thinking of things like Ellie Goldratt did when he said, "An hour lost in a bottleneck is an hour lost in an entire system." What I mean by this is, if we could just identify the one point in our business system that was slowing everything else down, and we addressed that one true bottleneck, we would have a instant increase in our happiness, right? And so what I want to talk to you guys about today is, how do I identify the one true bottleneck in my Amazon or e-commerce brand business so that I can address it? So let's talk about this. Listen, guys, if you and I were to buy a piece of real estate, let's say we're here in the States where I live, we're going to buy a piece of real estate. We would never try to determine how happy we are with that investment until we know what it cost us. What did we have to put into it to get that return? In other words, I want you guys to start thinking about your products with a return on investment mindset. It isn't enough just to say, I'm going to get a certain amount of profit. I got to take it a step further. Let me show you how to do that real quick. And by the way, Gary, feel free to stop me at any point if I say anything confusing or weird. So if you happen to be watching this in video form, you'll see a very basic profit and loss statement on the screen. This is pretty typical of $1 million, say, Amazon seller. We've got 30% in our cost of goods sold. We've got a bunch of Amazon fees. We've got some advertising, and we are left with 25% kind of real profit margin after ads and Amazon fees and COGS. This would be a fairly typical, pretty healthy Amazon account. But I want to teach you a couple of additional kind of KPIs or metrics that I want you to start keeping an eye on. The first one is called return on inventory investment. Again, if you're listening to this, I'm so sorry. It's in the video. Go check it out. But if you take that profit number, what was my true gross profit after ads, and I divide that by the COGS, so profit divided by the product cost of goods sold, that gives me, I like to think, I don't know if you guys like baseball. I like baseball a little bit here in Georgia. That gives me my batting average. How potent is this product every time I play the game? Just in case you guys are wondering, the closer I can get that return on investment to 100%, or even better, to be more than 100%, that's really good. If the return on investment is like 50% or less, that's not great. But just know you got to measure this kind of ROI. But let's take it one step further. What if we were to compare that ROI, which is our batting average, with the number of at-bats we get per year? This is the crazy thing about inventory, Gary, is that if I sell a unit, I get that dollar back and I can redeploy that same dollar to buy another unit. In other words, I get more at-bats per year without having to borrow more money if I just speed up my cash cycle and get my money coming back to me more quickly. Here's the bottom line. It's not enough to have just a profitable product. I need to compare the profits with the amount of time my cash is locked up. When I combine those two ideas, I get a metric called return on working capital. So just real quick, the math is, if I take that batting average, which is my return on inventory investment, times the number of at-bats I get per year. If any of you guys are like, EV nerds, game theory optimal kind of nerds, what is my expected value? Well, my expected value is my batting average times the number of at-bats I get per year. And what I love about this metric, Gary, is it allows me to compare any two products on any two marketplaces or platforms on any continent in the world. I can take up one product and compare its return on working capital to any other product, and I could tell you which one's more valuable, which one you should invest more money in, which one you should consider killing. So that's the broad overview. I'm going to show you a couple of examples to try to drive this home, Gary. But any questions about kind of the math of this?
Yeah, I think this is these two variables are super important. I love the baseball analogy. ROII, that's return on inventory investment. So if I
Yes.
understand correctly, you're aiming for as close to 100% as possible. and the second variable is inventory turns per year. That's kind of like the number of at bats you take. So that's like the number of times you can like sell through the order per year. Am I
That's right.
understanding that correctly?
Yeah, that's it. I think that you talked about the mistakes that sellers make, and this is where I'm just trying to make the point that if you sell inventory more quickly, by the way, the inverse of this is if you can wait and pay your suppliers until later, there are lots of
Yes.
things you and I can do, Gary, to make that cash cycle nicer for us. Making those adjustments, I'm trying to make the point, is just as important as profitability to the overall health of a
Yeah.
product or a brand.
Yeah. I can think of one example, Tyler, because you also mentioned, you can compare any two products on any marketplace on any continent in the world. So let's say if we compared selling like a widget that was manufactured in China and sold in the US versus the same widget manufactured in the same place in China but sold in Japan, which geographically is a lot closer. So if you look at purely the shipping, I mean, from China to the US, it's going to take 30 days and you got to get into the warehouse. So that could be another several weeks to a month, right? So that's like 60 days. But if it's in Japan, I mean, it only takes like a week or so from China to get to Japan. So you're drastically cutting that time shorter, right? So that would increase the inventory turns per year on the same product. Is my
Great
understanding
point.
correct?
And you're mentioning what are some of the variables that might impact this number? And I think you mentioned a good one. If I, similar to that example you made, sometimes people are like, well, should I consider manufacturing something in America to sell in America? Well, guess
Mm,
what, Gary? You and I could do that same math problem you just said. Well, it's going to be higher labor cost in America, but it's going to be lower shipping cost. And you can kind of just distill it down to this same formula. By the way, tariffs
right.
impact this also, right? Where you're going
Yes.
to look and all of a sudden that product cost of goods sold figure, oh man, now it's not 30%, now it's 40% because of tariffs. That changes
Yeah.
the math on this and it'll make that batting
Right.
average lower and it might
Yeah.
incentivize us to choose a different strategy.
Yeah. Yeah. Okay. Excellent. Well, let's keep going. What
Okay.
good stuff. What's next?
So let me give you a couple just kind of hard examples here. So whether this is company A versus company B, or whether this is literally just product A versus product B, on the screen, I'm just showing you two examples side by side. They both have $1 million in sales, let's say for a year. They both have the exact same landed cost of goods sold of a third, or a little less than a third, 30%. Product A is less profitable than product B. That stinks. It has a lower profit margin. Post advertising or true gross profit is only 20%, where product B is 30%. That means that because it's more profitable, product B has a better return on inventory investment. In other words, the batting average for B is better. But here's the kicker: the first product that we're looking at on the screen here only needs a third of the amount of cash stuck in inventory as the second product. In other words, this guy moves the inventory so much more quickly that product A or brand A, and again, it's hard if you're not looking at this, but I'm just saying, I'm making the argument that brand A is worth twice as much, double brand B. It's worth double because it deploys a dollar twice as effectively each year. And again, if you're looking at this, we're pausing on this slide enough that you can kind of take a look at it. But again, if you take that return on inventory investment, 66% times the number of turns per year, 3, you get a return on capital of 2.00. Whereas if you're the second brand, even though I have a much higher ROI, I only turn that inventory once a year. I've got to sit on a ton of cash. And so
Hmm.
actually at the end of 12 months, I am less happy. And this is what Gary sometimes blows my customers' minds. They're like, wait a minute, you mean to tell me I don't like my more profitable product? And what I have to tell them, Gary, is well, actually, in this specific instance, you
Hmm.
don't. Because you have to sit on a year and a half worth of inventory. That's terrible. It's going to be
Mm.
hard for you to actually get an ultimate return that you're happy with. And so, this might be a little bit of an extreme example, but my point is that brand B needs to take action to decrease the amount of noise in his or her inventory. And I'll show you some tactics here in a minute to do that. But any questions about this kind of comparison chart here, Gary?
I can kind of understand it based on the math. I mean, it sounds counterintuitive that you're going with a less profitable product because it's turning quicker. So I think it's like every turn it's making less profit, but you're doing 3 turns. So product A is having 3 turns a year. Product B is only having 1 turn a year. So it's like you're going to the plate 3 times. You're taking 3 swings versus just 1 swing, right?
That's it. It's almost like I'm kind of a scrub at baseball. I'm not very good. Gary's probably a lot better than me. But if you give me
I
10
don't know
at
about that,
bats,
but yeah, yeah,
you give me
yeah,
10 at bats, Gary, I'm going to get a hit eventually. And so
yeah,
the
yeah.
same, and by the way, if all things are fairly equal, like some of our clients only have one supplier, right? And so the inventory cash is going to be kind of equal among their products. Obviously, if that's the situation, guys, then you're going to be just looking at profit because everything else is equal. But I will say this, and I'm meeting with the CFO client later today, literally as we're recording this, where her
Hmm.
biggest challenge is that she has up to 2 years worth of inventory stuck in some of her sweetheart favorite products because they're profitable. But she's got to sit on
Hmm.
so much daggum inventory that it's hard for her to ever get that cash back. Let me drive this home a little bit differently. So regardless of how you choose to do the math, because people always ask me, well, Tyler, what exactly do you include in cost of goods sold? Or how exactly do you define this profit versus that? What I would say to you guys is just be consistent. I like having Amazon fees. I like having my advertising, whether you put DSP in there or not, I'm going to leave that on you. But I'm just saying have a consistent method of defining profitability. And the question is, if I run into a product that has great high velocity, I've got good annual turns, and it's really strong profit margin, that is what I call a superstar product. And I never, ever, ever want to stock out of that product. This is the one that has my highest return on working capital, where if I had to borrow additional money to keep additional inventory on hand, I'm going to. Right? Those are my all star products. Those are the true heroes, not just volume heroes, but return on capital heroes. And then obviously, if you have a product that has really poor velocity and it stinks on the profit margins, you got to kill the product. It's a dog. It's just not a good product. Time to stop being married to it. Those, to be honest with you, are not very interesting. The ones that are interesting are the ones that are kind of in between. What if I have a product that is really good velocity, but the margins stink? What do I do about that? Let me show you a couple things that I would consider doing if I had great velocity. I love the inventory turns, but I'm not real
Hmm.
happy with that return on inventory investment. I might consider doing things like raising my prices. I might look at holding my advertising team accountable, right? I might look at if I have a returns issue, do I have a quality, do I have a QC problem where I'm sending crap product to customers? There are things that I can do if I've been pretty happy with my velocity, but I really want to improve profitability, um, you know, and I'm going to employ these strategies if that's the case. So, again, if I have great velocity, I might be able to afford to buy a larger MOQ to get better pricing on the product because that'll improve my margins. So again, I've got two variables, speed and then kind of profit margin. The one I'm showing you here first is what if my speed is great but my margins stink? I'm going to take action specifically geared at improving those margins, even if it means raising prices and it might lower my velocity a tad. Because again, I can kind of find that equilibrium. Um,
Yeah, this
and
this
then
actually reminds me of like the BCG matrix, right? Like Boston Consulting Group, they had that the different variables. There's like the star product, there's the dog, and I believe this quadrant was the cash cow, like the one that was like high velocity but poor profit. So it is. I mean, I guess it is a cash cow, so to speak, but it's like not really. I mean, highly profitable. So I like these suggestions you said. I feel like one of the low hanging fruit is renegotiate supplier pricing. A lot of people are just intimidated by that, but I mean, it could be as simple as a couple of emails and like a conference call or even visiting the factory. I've done that before, and if you can do that, I mean, you're getting that bottom line profit like forever, or at least going forward, right? So
this
that's
is
a
a
great
good time to
suggestion.
kind of make the point. If you are a six-figure customer of any supplier.
Mm.
By the way, even below that, but for sure, if you are a six-figure customer, that means you buy your product more than $100,000 per year. It is an absolute mistake if you're not investing something like 5 to 10% of your energy each month, or maybe you have to hire someone. But you've got to be nurturing those relationships with your suppliers for the exact reason that Gary just said. I have so many clients I've worked with where they just haven't ever asked. They don't know if it's possible to get a slightly better rate, to get some kind of a discount pricing, right? To work with those suppliers. And Gary, this kind of feeds to the opposite corner of the same kind of matrix here. What if you do have a product that is, it's good margins, but remember how I told you earlier, there's these products where I'm having to sit on a year's worth of it. I've got way too much inventory, but I kind of like the product because it's high margin. Well, again, I might employ the lowest hanging fruit of just reaching out to my vendors. Hey, vendor, can I get better terms on the payments? I was paying you a 10% deposit and then paying the rest of the balance before it even left the shore in China. I've been a good customer. I buy six figures of product per year. Could I have a deal where it's more like I'm paying it once it gets to the warehouse here in America? And guys, I'll tell you, it may seem impossible, but I have friends and clients who get outrageously great cash terms from their suppliers. And you know why they get those terms? They ask for them and they nurture a long-term partnership with their supplier where they can come in and say things like, "Hey, I'm actually going to commit to a full 25,000 units for the year because I know you need to plan out your manufacturing capacity. In exchange for that, can I kind of get a lower rate per unit and have you drip it in for me where I'm not having to pay for it?" And you guys, if you'll develop those relationships, you might even have to dust off a passport and go kiss babies and eat some great Chinese food and drink sake, whatever they do over there. Right? You're going to go hang out with your friends, your
Yeah.
partners,
Yeah.
and you're going to develop
Yeah.
those relationships, right?
Yeah. Yeah. That's super important. And like what you said, like getting those type of payment terms. I mean, it's something that you can, build over time, over trust. But I think that's one of the levers that like a lot of sellers they never even consider that, right? I mean that's huge. Definitely, it's super helpful in
So
this respect.
here's a quick if you're going to kind of go home and look at your products, if you were to go try to do the math that I kind of showed you guys, back here a few slides ago, starting with the return on inventory investment, just kind of make this and close, Gary, and then we can talk about whatever you want to talk about.
Hmm.
If you have any products where your return on inventory investment, by the way, if you use Helium 10, if you use Seller Board, most of these tools, when they have the term ROI, like on the little chart, what they actually mean is the one I'm talking about. They're actually talking about return on inventory investment. So don't, feel free to use the math from the tools. But if you look at your product and the ROI is less than 50%, that needs to go on your alarm bells list of I need to find ways to improve my profit margins on this product. Likewise, if you look at your inventory turns per year, how many times am I actually selling through this inventory for this particular product? If that turns per year number is less than two per year, so I'm giving you kind of a rule of thumb here, two
Hmm.
times per year,
Hmm.
I am really going to be feeling a lot of cash flow crunch. So I can almost guarantee you this. I haven't even met you yet, but if you and I were having our first CFO call and you said, "Tyler, I just feel like I never have any cash in my business," I would ask you, "Can we take a look at your inventory turns per year?" You would show me, and it would turn out that those turns are like one. You're turning inventory once a year, meaning you have to keep all of that stuff in your warehouse for a year, and that's really stressful. And so that's kind of my advice. Go take a look at your products. If you take that batting average times the number of at bats, you can kind of compare apples to apples with any of your products or product lines. And, guys, for the ones that are your top quartile, like your top performers, they're high velocity and high margin. Never, ever, ever stock out of those. For the ones that are the worst, you may want to try to phase those products out. And for the ones in the middle, we're kind of looking at this matrix, right? Where our strategy is different depending on what our biggest challenge is. If the biggest challenge is profit, I want to raise my prices. I want to negotiate better pricing. I want to help my advertising team be more effective. If my biggest challenge is actually velocity, I love my margins, then I need to do things like getting better payment terms, I need to increase my ad budget. And I might need to lower my prices. My strategy depends on the problem. And so this is why I like to share this matrix. It isn't
Mhm.
a one size fits all. You need to take a look at what your product needs and manage those products accordingly. So that's
Yeah.
kind of all I have, Gary. Any
Yeah.
questions?
No, this is great stuff. Could you share a little bit more about building a better inventory control system and like I think you said hiring an inventory czar?
Uh, the illustration I'll use here again, because some people are going to be listening to this, is if I'm trying to drive a boat, let's say I have a big ship. If I'm out in the middle of the ocean, I don't really need to have great depth finders. I mean, I need to have good navigation, don't get me wrong, but I'm not going to run aground. I'm largely going to be able to, but if I'm going through the Suez Canal, all of a sudden I've got to have really good instrumentation to help me not run into the sides of the Suez Canal, as happened a few years ago. And so this happens with inventory. If I am, um, let me give you an example. If I have the desire to not have all of my money tied up in inventory, meaning I want to be able to thread that needle of not stocking out, having just enough but not having too much, I need to have really, really good metrics. I've got to really manage my inventory well. And so, system wise, there's a million softwares out there. Between you and me, most of them are not great, right? I mean, I haven't found anybody that's really been happy with most of the inventory softwares out there. But as an accounting partner and CFO partner, seller accountant worked with a bunch of them. Several of them are fine. Here's my point: inventory management is not a matter of superior intelligence. It's a matter of superior attention. You have to pay attention to your inventory so that you can place the orders when you need to place them and you can not place too many. And so you can either become better at that by having great software and managing that software, or you may want to go hire someone. I can't tell you how many of my friends and colleagues and customers have just bit the bullet and hired someone who their only job is to be the inventory czar. Like I'm looking
Mhm.
at the daggum spreadsheet every day. Okay, we're selling 5 a day. Got it. That means I've got to order on next Tuesday. Like they're just keeping an eye on it because guess what? You and me, we're busy. And we frankly are CEOs and don't always love the details of managing inventory. Sometimes we just
Mhm.
need to put some money into having somebody else manage it for us. And it's almost like advertising. I would be careful. I don't want to like over trust someone with it. I want to make sure I'm still keeping an eye on it. But it's
Mhm.
very important to just have a great system, technology plus people to keep an eye
Yep.
on the business. Because guess what? Whatever we spend on our advertising and our product launches, at the end of the day, we probably need to have the same level of energy managing our cash velocity, our inventory.
Yeah.
And sometimes we just neglect.
Yeah, that's really great advice. Can we touch upon exits? Like what I mean, what are you seeing right now is in terms of exits, is it a good time to exit and what factors should sellers consider before they exit?
Yeah, it's a good question. This is still not a very good time to exit as of the day we're recording this, Gary. Everyone who's
Mhm.
been around this industry more than like 3 years knows that there was a time right after the pandemic where outrageous multiples were being paid. I was the CFO for a number of like 7x and 8x kind of exits. They were really awesome. Really not happening right now. And they're not happening because interest rates are high, tariff uncertainty is scary. And that combined with the fact that we're feeling some recessionary pressure just has everybody kind of tightening the purse strings and not really buying things. Here's what I see though. I have a very strong sense, just based on some people that I follow that are really good at the macroeconomic things. It does seem very, very likely that Fed interest rates here in America will go back down sometime in the next 6 to 7, maybe 8 months. That will be really good news for you if you were hoping to sell your business. That's going to free up the capital markets. It's going to be easier for buyers to get through SBA lending and get a loan. It's going to be easier for the private equity and venture capital guys to invest in businesses like yours and mine. And so, my advice to you would be if you're, I can't tell you how many of my friends have been like, darn it, I wish I'd have sold in like 2021. Why? And now you've been kind of tightening down your business. You've been improving it, making things work better. My just my instinct is to start getting ready. it's going to be probably a year. My guess is that somewhere around a year from now might be a better time to exit than it is right now. But start, documenting a few basic processes. Start culling out those bottom feeder products that need to be eliminated. Start prioritizing return on working capital for your portfolio. And then when the sun does shine again, which I think it will in the next year or so, you'll be ready to go to market quickly. Final nugget I'll give you: know your number. Have an idea of what your goal is. And that goal can't just be an arbitrary number you thought back in 2021 when everyone was getting 7, 8x multiples. That may not be
Hmm.
a realistic. What is your number right now? Because I had two clients, Gary, that were offered their number and wanted to hold out for more because they were having some FOMO, and they
Hmm.
ended up not getting their number later on. And so you got to know what your objective is with this investment so that when you
Hmm.
get that number, you can with confidence get out of the business.
Mm, that's really good advice. What is like a ballpark number that's realistic these days?
In terms of multiples,
Yes.
yeah, so I'll give you a couple things to think about. The more profitable, the larger, the more consistent your growth, and the less like faddish the products are. In other words, if you were selling exercise equipment when everyone was working out at home back during the pandemic, that was a very faddish product, right?
Yes.
But the more evergreen your products are, the more consistent the growth and the more profitable they are. And then ideally, having mid seven figures in revenue, and even better, maybe seven figures in profit.
Mm.
Uh, maybe if you, so all of those things are check, 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 right? I've got good yeses there. Then I might be able to get more like a 4x or a little bit more multiple at the moment. If
Hmm.
I'm kind of the typical $2 million Amazon seller with, maybe $500,000 in seller's discretionary earnings, I'm going to be getting like a 2.5 to 3.5x multiple right now. And
Hmm.
and that's okay. The things that also add value is, can I find a path? Does my product have a natural path to owning my customer's journey? Some products don't. I have a client that sells paper bags. He doesn't need to go on TikTok with paper bags. He doesn't need to go on Shopify. It's paper bags. But for
Hmm.
the guys that sell the fancy wallets that are my clients, they sell fancy wallets. They've got a
Hmm.
great TikTok presence. They've got a great Shopify presence. Oh, yes, they sell on Amazon also. Those multi-channel efforts for the right products really drive up the multiples.
Yeah. Okay. Great advice. All right, Tyler. For people that want to learn more and connect with you, what's the best way?
Well, yeah, thanks, guys. I would love to talk to you if you're interested in a high level kind of intimate mastermind with me. He'll give you the link, but thesellerroundtable.com is my little rudimentary website for the semi-retired guy that sold his company. Pretty easy to find on LinkedIn. I also just I highly recommend, if you are looking for bookkeeping, I still send everyone I know to the guys that bought me. They do an awesome job. So Seller Accountant is a great. I don't get paid. I'm not even getting paid to say that. At this point, I'm gone. I just like these guys. It's a good team. I put them in place. So if you're looking for accounting, get those guys down.
Excellent. So we'll link that up below in the show notes. High value mastermind seller roundtable at thesellerroundtable.com. Reach out to Tyler on LinkedIn, and also seller accountant for bookkeeping. Tyler, before we close out, can we do a quick lightning round, rapid fire Q&A? All right. What is a favorite book or podcast you'd recommend?
Okay, so a book I just finished. I'll give you two that I loved. One is Think Again. Very interesting book on how we get stuck in our mindset and don't like to see evidence against it. So as an entrepreneur, we cannot afford to be wrong for long. We can be wrong all day long. We just need to have mechanisms for not always believing our own BS.
Mm-hmm.
Think
Mm-hmm.
Again, really interesting book there. And then Thomas Jefferson's biography. I finally went and listened to that. The one, I believe it's called The Art of Power, 2012 biography. Fantastic. What an amazing, interesting,
Mm.
hypocritical, genius life that this guy led. So those are two books that I'm really interested in. In terms of podcast, I really like Ben Thompson's Stratechery. I highly recommend checking that out if you want to know, how does AI interact with the current economic markets and nerdy technology meets economics stuff. he has like a paid version that you can buy if you want to, but he also just has free podcasts that come out every other week or so that'll just give you like a 20-minute snippet on how Google is doing versus X in terms of building AI and really cool stuff like
What's
that.
the name of that podcast again?
So it's like stratechery. So he's kind of made up a word. So it's like the combination of strategy and technology, right? Stratechery.
Okay.
Ben Thompson is the dude. He's a genius. He's really, really smart. Yeah.
Sounds good. And on a personal level, how do you stay ahead?
I my game winning strategy always starts with my morning routine. So I fight tooth and nail to have. I was up late last night because I had some friends here. We were playing cards. We had a great time. I still was the first one up this morning, not just because I got to meet with you, Gary, but because I wanted to have a cup of coffee on my screen and porch with my quiet time routine,
Mm,
reading, journaling, meditating.
mm.
When I do that and I combine that with exercise, I win. I win the day more often.
Awesome. Okay, and last question. I'm all about the 80-20 rule, the Pareto principle. What if you could distill down everything that you shared with us today, what would be the number one recommendation to sellers out there looking to choose their profitable product?
Well, oh, I love that. I love that question because the return on working capital is applying the Pareto principle to managing your catalog. So if I could stack rank every product, let's say I have 10 products, I'm going to put them on a spreadsheet and I could calculate that return on working capital. So batting average times the number of at bats. My top, if let's say I have 10 products. My top three products, I'm never ever going to stock out of. My bottom three products, I'm going to get rid of them if I can't make them better. And my middle products, I'm going to do the things, Gary, that you and I talked about, which is either improving payment terms, hiring a czar, or improving margins by raising prices.
Perfect. Thank you so much, Tyler. Super valuable training today. I hope everybody can apply what Tyler shared with us to choose their profitable products and make their products more profitable. Wishing everybody a successful Q4 going forward, and we will see you at the next session. Bye, everybody.